if we are about to experience, some people would say soft landing. I find it hard to believe this will be soft, but soft or hard landing, what that will mean is inflation and interest rates are going to continue coming down, and the Fed will follow them finally. The markets always lead the Fed. So that could be what's going on here. If you remember what happened, our strategies, innovation-based strategies, they started underperforming in February of 21 when the whiff of inflation and interest rates going up with supply chain issues started. And the market just started discounting, saying, oh, interest rates are going to go up at some point. This category of stocks is not going to do well.
ARK Invest CEO and Chief Investment Officer Cathie Wood begins by talking about the recent banking crisis and the Federal Reserve's response, which included an unprecedented 25 basis point increase. She also expresses concern that the Fed is ignoring economic indicators and market signals, and she brings up the upcoming 25 basis point hike in early May. She also discusses the debt impasse, noting that an increase in the debt ceiling is necessary and could occur in June. Wood also touches on monetary policy, noting the unprecedented 30% drop in M2 growth since the 1930s. This decline has resulted in negative year-over-year M2 growth. As a result, she has been sounding the alarm for the past year. The markets are trying to figure out whether or not she is referring to a slow-moving crisis or hard landing. Cathie Wood says the decline in the dollar since September 2020 has been a welcome relief because the peak and bond yields last year were highly deflationary and hurt the rest of the world. Bitcoin and Ether, she says, have acted as flight to safety assets during the COVID-19 crisis. Cathie finds this to be an intriguing trend, as it may indicate a wider adoption and acceptance of cryptocurrencies than most people realize, especially in light of the government's pressure on cryptocurrencies. She forecasts that many innovations, such as cryptocurrencies, will shake up the established global order and that the flight to safety trend will persist.
The debt impasse still seems to be out there, and it looks like raising the debt ceiling, the imperative will come sometime in June, we think. So we'll have another few months. It doesn't seem like there's much movement at all. And yet we know that Republicans and Democrats don't want to go through another 2011 where the ratings agencies downgrade our debt. So we assume they'll figure it out, but so far, very little movement there. The one thing that is becoming clear, and this is really a throwback to the early days of my career, the bank crisis seems to be facilitating, in a sense, what we used to call crowding out back then. Really, the public sector crowding out the private sector. And how is that happening? Well, we're seeing deposit outflows from the banking system, so that's the private sector, into money market funds and especially treasury securities, a little bit of a flight to safety. So what is that doing? It's actually accommodating spending, government spending. And so we're watching this carefully. If it's accommodating government spending, what will it be crowding out? And we'll get into this in a moment, but it does seem already that the commercial real estate space is one of the victims. So this could be just a slow-moving crisis, we don't know. But getting into monetary policy, it could be a slow-moving crisis, or are we talking about a hard landing? And I think, the markets are a little bit on pause now, trying to figure out, did the Fed and the FDIC come in and, rescue the banking system from a run on the banks? So far, so good. But I do think the markets are stepping back and saying, is that all there is? What else could happen now? And there are a lot of things we think that could happen now. We all know, of course, it was the regional banking system. And it has highlighted two major mistakes that banks made. Both of them actually were very understandable, but they were mistakes nonetheless. And they made those mistakes in the middle of COVID, as the crisis was unfolding. They took a look at the Fed's forecast through the end of this year and saw that the Fed was forecasting that interest rates would go nowhere. They'd stay very, very low, move hardly at all. And so it made sense back then to take the gusher of money coming out of fiscal stimulus and ending in bank accounts and put that in very safe, long-term, government-backed securities, yielding 1.5% or so. Remember back then, the Fed funds rate was 0 to 0.25. So it made sense back then. So the first assumption they made was that interest rates would not go up very much, if at all, which is what the Fed was telegraphing. And of course, in 2022, and over the course of just 1 year, interest rates went up 20-fold. Never happened before. 20-fold, up to 5%. And that was a shock to the banking system because with such low-yielding securities on the asset side of the balance sheet, it was very difficult for them to pay up for deposits on the liability side of the balance sheet. And so what happened? What happened was deposits flowed out and into money market funds, so out of the banking system. Most of the statistics that have come out recently, that they were taken, or the measurements were taken pre-regional bank crisis. So I'm not sure we should pay too much attention to them. The positive ones were on housing, and I think it's because mortgage rates have come down since the long-term Treasury bond yield peaked last October at 4.3%. Finally, mortgage rates started to come down. So housing starts, permits, mortgage applications, existing home sales, and pending home sales all have done a little better. I mean, housing by many measures was down 40% year over year. So I suppose we shouldn't be surprised to see some rebound there. Autos they're still in recession territory at 14.82, but they came in a little better than expected. But other than that, even before the crisis, a lot of indicators were starting to signal trouble. So employment indicators like job openings have come down fairly dramatically. They peaked at 12 million at one point. Now we're down to 9.9. The Challenger Job Survey of layoffs, which are the larger layoffs, that's up more than 400% year over year. And maybe the most important indicator is initial claims, which were revised recently. And at turning points, as I've mentioned on this webinar before, at turning points, we see massive revisions. Well, such was the case with initial unemployment insurance claims, and that's a weekly indicator. So we have some of those since the crisis, and the revisions are up 25%. 25% in an indicator that the Fed's really paying a lot of attention to, and so are the financial markets. So that was kind of interesting. And then if you look at the various regional Fed indices, they're all disappointing. So the Philly Fed, the Dallas, Richmond, and so forth. The 10-year Treasury bond yield peaked in October last year, 4.3. It did get to 4.1% in March, but then the crisis took care of that. And we're now down to roughly 3.5%. So we're down to 3.5%, perhaps because of a flight to safety, and perhaps because whatever kind of landing this is going to bring with it lower inflation and interest rates. And if deflation is the risk, that actually accrues to the benefit of stocks that do well during deflationary times. And that tends to be technology. Technologically enabled innovation is deflationary. Now, the yield curve is telling us that we're not out of the woods yet either. It did drop to more than 100 basis points of inversion on March 8th, and the crisis took care of that. But we're still inverted at 58 basis points today. So now many people looked at the 100 basis points and they said, oh, well, the last time we were here was in the early 80s. We got inflation under control with 100 basis points inversion back then. And that's true. But I think the analysis is a bit off. It basically underestimates how powerful Fed restraint is today, because 100 basis points or 1% against a 15% long bond yield is a lot different from 1% against a 4% bond yield. So 1 over 15 is 6.5. Use the Richter scale here. 6.5 on the Richter scale is a pretty powerful earthquake. I've been in a couple of those, and they are not pleasant. They're actually quite eerie. 1 over 4 would be 25 on the Richter scale. We've never seen an earthquake of that magnitude. In fact, I think the highest has been 10. So I think if we look at it from that point of view, that the Fed has been making a mistake, and we are going to see more ramifications of this.
What do you think the next big step will be? Leave a comment and let us know what you think. That's all for today's video on Market Empire. We hope you found the insights shared valuable and informative. Don't forget to subscribe to our channel and hit the notification bell to stay up to date with the latest news and insights from the world of finance. If you have any questions or comments, feel free to leave them down below. Thank you for watching, and we'll see you in the next video.